Hello and welcome to Follow the Money. I'm Raine Musñgi. Join us as we explore the tools and insights you need to jumpstart your financial journey. We begin in China, where it's revealed plans to tighten export restrictions on certain technology used to make battery components and the processing of two crucial metals amid rising trade tensions globally. A notice seeking a public opinion released by the Ministry of Commerce on Thursday shows Beijing proposes including battery cathode material preparation technology to its catalog of applications that are subject to export bans or restrictions. The ministry also plans to enhance curbs on some technologies and processes for extracting metallic gallium and lithium. Xinhua News Agency reports the proposed change is part of efforts to strengthen the management of technology imports and exports. The public can provide feedback to the proposals until February 1st. China's proposed technology export restrictions came a month after authorities announced a ban on several materials with high-tech and military applications, widely considered a tit-for-tat move after the U.S. government escalated technology curbs on Beijing. Tesla's annual vehicle sales dropped for the first time in more than a decade, despite a year-end push that sent deliveries to a record in the fourth quarter. The Elon Musk-led company sold 1.79 million vehicles last year, which was slightly less than what it delivered in 2023 and also below analyst consensus estimate. Meanwhile, Chinese competitor BYD sold 4.25 million passenger EV and plug-in gas-electric hybrid models last year, narrowing its gap with Tesla as the top electric vehicle maker. The results offer a sobering reminder of the real-world challenges for EV makers, even as hype around driverless cars and Musk's closeness with President-elect Donald Trump have sent Tesla's stock soaring in recent months. Lukewarm consumer demand is weighing on sales of electric cars, an issue that could be exacerbated by Trump's push to rein in EV incentives. Tesla's shares sank after the results, falling 5.8% in New York. The stock rose 63% in 2024. Still, Musk told investors on Tesla's latest earnings call that he sees 20 to 30% growth this year, 2025, fueled in part by a more affordable vehicle expected to be unveiled in the first half and on the company's autonomous technology. On to Wall Street, the U.S. market seesawed on a lower close on Thursday amid choppy trading. That's as investors embarked on a new year facing the cross-currents of solid labor market data, a rising dollar, and tumbling Tesla shares. All three major U.S. stocks ended the session in negative territory, a reversal of an earlier rally but off session lows. Shares of Tesla sank after reporting its first annual drop in deliveries as incentives failed to stem a decline in demand for its aging lineup of electric vehicles. A report from the U.S. Labor Department also showed initial and continuing claims for unemployment benefits both fell last week, supporting the narrative of a solid jobs market and adding weight to the possibility that the U.S. Central Bank could let its key interest rate stand at this month's policy meeting.
So we closed 2024 on a bit of a rough patch, and I think that in lieu of a catalyst or big news, the prevailing trend kind of takes over, right? And while the market started off on a nice foot this year, the prevailing trend lately has been the market working out some bullish sentiment, some overbought conditions, and we continue to see that today. And you see the dollar pressing higher, you see the 10-year pressing higher. Those have been two things that have really weighed on stocks, and that sets us up for what I think is going to be a much more volatile 2025 than we saw in 2024, 2023 even. I think that this is kind of par for the course.
European stocks wavered on the first trading session of 2025 after a late year sell-off that was driven by concerns about high valuations and policies under incoming U.S. President Donald Trump. The Pan-European Stoxx 600 index dipped by 0.2%, reversing modest opening gains as trading volumes were light, with investors still returning from their New Year holidays. The benchmark Stoxx 600 suffered its worst quarterly drop in more than 2 years from October to December, weighed down by uncertainty around the interest rates and the Trump administration's policies that several market participants fear will boost inflation. One Frankfurt analyst expressed hope that a European deal with Trump might still be a possibility. He considers recent comments and agenda on German politics and the upcoming election by U.S. billionaire Elon Musk bizarre.
So what Elon Musk is currently really pushing via various platforms, mainly via his platform, of course, is quite bizarre. For one thing, he is not yet in office. It is not even known whether he will actually get an office. In the US government and beyond, it is actually not the done thing to constantly comment on other countries' policies. This is very, very dubious, and that's why I actually believe that Musk won't survive too long in a possible Donald Trump administration. One of the worries shared by many investors is, of course, the current politics, for example, the future policy of the new President Donald Trump. He has announced that he intends to impose various tariffs. He has already described this in great detail for Mexico, Canada, and China. He has only reserved the right to do so for Europe. He probably still sees room for negotiation there. In other words, we definitely take a critical view. Certainly with a very worried view. Nevertheless, something good can also come out of it because the worries are great at the moment and the chance of perhaps sharing the risks or a deal with Donald Trump could still happen.
Austria says it plans to import natural gas from Germany and Italy to mitigate the impact of the halting of Russian gas through Ukraine. The Austrian gas grid management confirmed on Wednesday that gas deliveries through the affected pipeline network have ceased, but stressed that Austria's energy sector had been prepared and that domestic gas supplies will remain secure. The Austrian government gave assurances that gas shortages will be avoided through additional imports from Germany and Italy, but many believe that higher gas prices are inevitable. Experts from the Energiekontrolle Austria, or E-Control, said the Austrian Regulatory Authority for the Electricity and Gas Markets forecast a short-term rise of 3 to 10 euros per megawatt hour for natural gas. Austrian newspaper Wiener Zeitung has also reported that while gas prices are unlikely to soar as they did when the Russia-Ukraine crisis erupted in 2022, even a 10% increase would represent a significant financial burden for households and businesses, which could further pressure inflation. Poland's business operators are struggling to stay afloat with soaring energy prices and a challenging market situation pushing them to the edge of bankruptcy. It's after the European Union and United States imposed multiple rounds of sanctions on Russia. Before the Russia-Ukraine conflict, 45% of Poland's natural gas or gas demand came from imports from Russia, but as the EU imposed energy sanctions, the price of natural gas in Poland has skyrocketed. Now, since the outbreak of the Russia-Ukraine conflict, Poland has been in a state of high inflation with average inflation rates of 14.4% and 11.4% in 2022 and 2023. Now, although the figure fell back to around 5% last year, high prices are seriously affecting business operators and local residents. To keep costs down, some bakers have decided to stick with the old gas oven instead of newer, more efficient models.
Russian gas used to be cheap, and gas prices used to be quite stable. We paid an average of 6,000 zlotys, about $1,459 a month. Now the monthly bills are so high that we can't plan anything for the future. We pay twice as much as before, and when the price increase was the worst, we paid 4 times as much.
Definitely energy shock hit Europe. This is still visible. The energy prices are high here. It's hard to expect the price drop. Right now we are changing the mix to our, let's say, more renewable sources, being less dependent on the import of, for example, natural gas from Russia. This, of course, has its costs. Like this is probably more expensive, but I think it's hard to imagine right now any other options. Definitely, this energy crisis, the shifts in the supply chain of energy commodities affects the overall cost for the companies. Well, I think this will reverberate in the coming years. So I think we will learn to live with this higher cost.
Coming up in a moment, what's the biggest mistake the Philippine property sector could make in 2024? Stay on BNC and follow the money.
Get into a new adventure with every Happy Meal. Starts at 96 pesos.
BNC's Election 2025 Special Coverage.
Welcome back to Follow the Money. Personnel from South Korea's Corruption Investigation Office enter the Seoul residential compound of impeached President Yoon Suk Yeol to try to enforce an arrest warrant. He is wanted for questioning in multiple investigations, including accusations of leading an insurrection due to his martial law declaration in December. This is punishable by life imprisonment or even the death penalty. A court on Tuesday approved the warrant for Yoon, the first time such a move has been taken toward a sitting president. The suspended president has remained defiant in the face of investigations, an impeachment trial underway by one of the country's highest courts. Both the Korean Kospi Index and the Korean won rising today with the development. China has revised upwards its gross domestic product in 2023 by 2.7%. While releasing the fifth national economic census, China's National Bureau of Statistics revised the GDP from over a year ago to $17.7 trillion. The agency said the revision of 2023 GDP would not have a significant impact on China's 2024 GDP growth rate.
总的来说，2023年 GDP 核实后。
Overall, after the GDP for 2023 is verified, the total GDP in 2024 will change somewhat. But the GDP growth rate calculation in 2024 will not be significantly affected. Of course, we also need to recognize that at present, China's structural employment issues are still prominent.
On Thursday, the World Bank raised its forecast for China's economic growth last year and this year, but warned that subdued household and business confidence, along with headwinds in the property sector, would keep weighing it down next year. The economic census data showed as severe property crises hobbles a macroeconomic rebound, employees of property developers fell 27% to 2.71 million by the end of 2023 against the corresponding 2018 figure. Here at home, a public finance analyst criticized the Marcos administration for its approach to the 6.3 trillion peso General Appropriations Act. Now, even after President Marcos's veto of 194 billion pesos worth of line items in the budget, I-Lead Executive Director Saiza Susara still warned of the potential misuse of the funds. Now, while the administration claims this ensures alignment with the Philippine Development Plan, Susara called the veto inconsequential and warned that it prioritizes pork barrel allocations over critical sectors like education and health.
Kung totoong nakikinig ang presidente sa kung ano ang kailangan ng bawat sektor ng lipunan, uunahin niya dapat pondohan kung ano yung mga programs and projects na nakasulat sa Philippine Development Plan. Kaya lang ang nangyari, ang inuna ng BICAM ay yung kanilang mga pork barrel.
Suzara also raised concerns about electioneering ahead of the 2025 polls. She warned of billions in congressional insertions potentially funding political campaigns rather than programs benefiting ordinary Filipinos. Her recommendations include prioritizing education, health, and agriculture in next year's allocations rather this year, and cutting pork barrel funds entirely. For the first time since 2021, prices of residential real estate in the country went down in the third quarter of 2024. Details from Sujin Kim.
Residential real estate prices in the National Capital Region plunged by 14.6% in the third quarter of 2024, the sharpest decline in 3 years. This drop also contributed to a 2.3% year-on-year contraction nationwide, the first since 2021. According to Joey Bondoc, Director of Research at Colliers International Philippines, the decline is part of an industry-wide correction in NCR due to a surplus of condominium units.
Talking about 50 to 60% decline in take-up of pre-selling condominium units in Metro Manila. You have how many? 75,000 unsold condominium units in the pre-selling as well as secondary market. And given that Metro Manila at this point is flooded with a sizable number of unsold condominium units, it will take about 6 years, nearly 6 years, for that inventory to be absorbed by the Metro Manila market.
The concern of pagbaba ng price is basically, for me, it's a temporary scenario. Everything is a cycle, basically starts from recovery towards expansion, where people buy a lot of units, and then comes hypersupply, which we are experiencing right now.
Data from the central bank also shows that residential real estate loans nationwide dropped by nearly 16% year-on-year, attributed to negative consumer sentiment and high interest rates.
A sizable impact because especially in the mid-income segment, that is the most sensitive to interest rate and mortgage rate spikes. High interest rates resulting in high mortgage rates, and then essentially you don't have a lot of employees right now that are renting the condo units because the POGOs have left the Philippines.
Bondoc adds the exit of POGOs and the rise of remote work have also reduced rental demand, causing a double whammy for condominium sales.
Vacancy in the office market in Metro Manila, 20.5%. Essentially, 1 out of 5 floors is vacant in Metro Manila. So, because of this lower demand for office space, that has also resulted in a sluggish take-up for condominium units.
While the NCR market is experiencing a slowdown, demand in suburban areas such as Calabarzon and Central Luzon continues to grow. Horizontal developments, particularly house and lot projects, are gaining popularity for their affordability and spacious options.
So you have developers such as Rockwell, for example, in Bulacan, Batangas, Ayala in Angeles City, Mega Road in Bulacan, Robinson's Land in Tarlac. So they have been launching all these horizontal projects, and they're really banking on the sustained demand outside of Metro Manila, again supported by the shift to suburbia. And so I think it's a diversification game at this point.
Prices outside NCR saw a 3% uptick, supported by single detached houses and condominiums. Despite the challenges, property investor Eric Manalo remains optimistic, pointing to the country's robust tourism arrivals, infrastructure development, and the contributions of BPO and OFWs to the real estate sector.
The main declines in Metro Manila, based on that report, will basically give an opportunity for buyers today to avail of a property at a good price and flexible terms.
Manalo recommends following the buy, rent, sell model to secure reliable sources of income for future benefit.
The more you wait in buying property, the more you lose, because Before, Makati was like 280 pesos per square in the 1970s, and now it's hundreds of millions.
Sujin Kim, Bilyonaryo News Channel.
Taking off from that story, the property sector is facing a dynamic landscape with new challenges and opportunities emerging in 2024. Now, from Metro Manila's 6-year residential inventory clearance to the rising demand for green office spaces, let's take a deeper dive into how stakeholders are navigating a mix of optimism and caution. Today on Follow the Money, we welcome Joey Roy Bondok, Director for Research at Colliers International Philippines, to share his insights into pressing issues and the road ahead for the industry. Good to have you back, Joey. Thank you so much for making time for us.
Yes, of course, Raine. Happy New Year.
Happy New Year and good morning. Now, with about 154.4 billion pesos worth of ready for occupancy or RFO inventory that is yet unsold. So is this a sign of oversupply? What does this mean for developers still building more? What kind of issues, or should it be a sign of economic caution? Do you think that such figures affect the confidence of both small investors and home buyers?
Yes, definitely, Raine. We have an oversupply in Metro Manila right now, especially when you talk about the unsold ready for occupancy units. But I want to highlight that the problem primarily lies into the mid-income segment. So this is the 3.6 to 12 million pesos per unit, 154 billion pesos worth of unsold inventory in the Metro Manila condominium sector. And about 57% of that is from that mid-income segment. The upscale luxury segment only accounting for 5%. What does that indicate? There's still a very good take-up for the higher price condominium units. But for the mid-income segment, this is the sector that is struggling at this point. Why? Because of elevated mortgage rates. Interest rates are still high. And of course, the central bank has been cutting interest rates, but the impact is likely to be felt across the residential sector mid of 2025 earliest. So it will probably take a bit longer before we see the full impact of that interest rate reduction into the residential market and having a positive impact and eventually stoking demand, especially for the mid-income condominium segment in Metro Manila.
Meanwhile, would you describe it as a bubble or a property bubble here in the Philippines that's just burst?
We do not see it as a bubble that is about to burst the rain. Why? Because while we see an oversupply in Metro Manila, developers are now starting to turn off the supply tap. What does that indicate, and what does that mean? For example, in the Metro Manila residential sector, launches for the first 9 months of 2024 down by about 60%. And completion will likely be at about 8,000 units every year from 2024 up to 2026. This is much lower compared to 13,000 units, condominium units completed every year from 2017 to 2019. Of course, you can argue that during this 2017 to 2019 period, this was positively influenced by the POGO demand. But we no longer have the POGO sector right now stoking and reviving demand in the condominium sector. So it's really the foreign investors, local buyers that are fueling take-up in the Metro Manila residential sector. But I think, Raine, what I want to highlight here is that while we see tempered launches and take-up in Metro Manila, we see the shift to suburbia, meaning developers are launching more horizontal projects, house and lot only, as well as resort and leisure-themed developments outside of the capital region. And I'm talking about regions including Central Luzon, Calabarzon, Western Visayas, Central Visayas, Davao, and of course, Northern Mindanao, including Cagayan de Oro.
It's an awesome insight, actually, especially as you mentioned resorts and leisure-themed properties, because in ASEAN countries like Thailand and Vietnam, they're seeing faster recovery in tourism and property markets compared to the Philippines. Now, Manila has only 65,000 hotel rooms compared to Bangkok's 75,000. Do you see the Philippines as being able to possibly catch up competitively in attracting foreign investments into this sector?
Well, we see that Raine, because if you look at Metro Manila, we are projecting the completion of about 2,300 new hotel rooms from 2025 up to 2027. And what's interesting is that of these rooms, 40%, nearly 40% are foreign brands. So we now see the likes of Accor, Ascot, Mercure, Banyan, all these foreign brands, Radisson, for example, that are expanding their leisure hospitality footprint across the Philippines, not just in Metro Manila, but even in key destinations, the thriving, the rising destinations, including Panglao in Bohol, that will have a 3W Marriott. You have Dusit Princess in Cagayan de Oro, as well as Bukidnon. So these are outside of the traditional, the most attractive known locations such as Cebu, Bacolod, Iloilo, Davao. But we now see more thriving locations. Why? Because these foreign players are taking advantage of improving hotel occupancy. In Metro Manila, occupancy is 63% from 20% at the height of the pandemic. And we believe that given that the government is setting its lofty goal of 12 million international arrivals in 2028, there's really tremendous opportunities for foreign brands to proliferate and continue expanding their footprint across the Philippines.
Right, and offline we were already talking about the proposals of the government to review the current ownership and lease agreements with foreign brands and foreign investors. How do you see this as potentially affecting the property sector here?
It will have a very positive spillover impact on the property sector, Raine, because if you look at the industrial sector, you have foreign manufacturers that are investing massive capital, billions of dollars. Texas Instruments, for example, $1 billion for their expansion. You have St. B, Gigafactory, a manufacturer of electric vehicles. And of course, since they invest billions of dollars of capital, of funds into the Philippines, they want a longer lease term for their properties. And we believe that this land lease bill currently pending in Congress will do positive wonders, benefits for the Philippine property sector, especially industrial segment and even hospitality. You have foreign brands, for example, such as Four Seasons. They want a longer land lease term whenever and wherever they invest. So hopefully, once this bill is signed into law, I believe that it is already at third reading, both chambers of Congress, and will likely be passed before the busy election campaign season. It will help attract more foreign brands, including Four Seasons. So who knows? We might see new Four Seasons. I understand that the government already announced they are already in talks with Four Seasons. And that is another interesting brand that will be added to the Philippine leisure landscape.
All right, Joey, in our last minute, just two remaining questions and probably very quickly. Green office spaces, is there still a push for sustainability, especially in which sector? Plus, perhaps looking at your outlook for the property sector, are there still gaps that perhaps the private and the public sector need to fill to be able to prop up the property market?
Definitely, Raine, because we believe that right now the office market is seeing challenges. The vacancy in Metro Manila is 20.5%. That is the highest that we have ever recorded. But we believe that the demand for green, sustainable, healthy office space will help revive demand in the Metro Manila office segment. You have 1.2 million square meters of new office space that will be completed across the capital region from 2025 up to 2027. And about 60% of that, or about 720,000 square meters, are considered green, healthy, have green building certifications. As we always say, at Colliers Philippines, sustainability is every Filipino's responsibility, and green is in. You have a lot of multinational companies, large Filipino firms that are highlighting their ESG goals, sustainability initiatives. And we believe that, for example, if you're a parent company of a BPO that is located in a healthy office space in the United States, you need to walk the talk. You need to ask your subsidiaries in the Philippines to also be located in this green, LEED certified office spaces. So this is one trend that we're likely to see moving forward. Green initiatives will be the norm beyond 2025 and will really play a pivotal role in reviving demand in the office space sector.
All right, good reminder right there. Joey Roy Bondoc, Director for Research at Colliers International Philippines. Grateful for you sharing your expertise and fearless forecast. Thank you so much.
Thank you, Raine.
Now, before we go, we leave you with this thought from UN Habitat, the world agency focusing on sustainable urbanization and human settlements. Sustainability is the bridge between today's challenges and tomorrow's success. And that is it for today's edition of Follow the Money. I'm Raine Musñgi. Thank you so much for watching. Keep it here on BNC, the Bilyonaryo News channel, always on top.